Traders, what's going on? Cleveland here. Awesome topic. Everybody's freaking out about the price manipulation on the Euro USD this week. You should have been expecting it. The technicals lined up to tell you that price was going to go lower, but it didn't tell you that it was going to go at the pace it did. That was surprising. A 200 pip drop isn't very average on the Euro USD, but I want to go into the technicals to show you why it dropped, why I'm not going to say I forecasted it, because if I did, I would have been in a trade. But I did have indications that the euro was going to go lower. But I've been out the market since Tuesday. You can check some of my videos. I pretty much closed out after around 150 pip gain on the Audi and the GU. So let's go into the charts. This is my analysis post drop. Okay. I want to go over what this means and how I concluded off of this information that the euro was ready for some more downside momentum. So I'm going to clear off the charts for you and start from scratch. Let's see what we got. Alright, so first things first was a trend line that I saw forming probably on Sunday or Monday, and I just left it on my charts. It was pretty obvious. There's not much expertise that need to go into this right here. But after that, all I do usually is every day I'll extend this to the right. So every day I kept seeing this happen. Okay, it was a little bit more on top of that green candle. So I'm gonna activate myself for you. And let's see what we got. So this is about where I had it. It was a little bit sticking out. So when I saw price marching over, I potentially said, wow, okay, so that could act as some type of resistance for sure. Not only that, on the 4-hour, one of my obvious key levels were at that area. So I want to throw up that resistance for you as well. Let's see what we got. So if you notice here, there was a huge MA convergence type situation where price moved fast. And I'm not an MA player myself, but it definitely works. I definitely used it as confluence. Okay, cool. So if you notice right there, we got a little price action on this level, definitely, and that adds up perfectly to look exactly where price flipped. Okay, so remember, market makers are going to use key levels as areas to move the market. Why? That's because at key levels you're going to have a lot of stops, you're going to have a lot of order flow. That's the only way that they can move the market, with heavy order flow, heavy liquidity. And that's exactly what happened. But we're going to go into the manipulation after the technicals. So let's draw up my Fibonacci's, my favorites. Basically, price came in right at a 50% Fibonacci retracement. I always draw from the most previous swing. So if you notice here, boom. Now check out what we got going. We got some confluence going, guys, don't we? Okay, you don't need an exact entry into the market. That's what drawdown's for. Okay, you're not going to be a pip on. But if you know to place your trade right here in this area of congestion, then you can have a lot of, you're not going to be too off. You're not going to sit in this trade 50, 60 pips, in the wrong direction. But it's not going to be perfect either. So just understand that. Not everything's going to line up to where it's just a pip in, you say, this is my entry. Find out where your entry is by concluding your best, the best areas, evolved around where the key levels are, and best for your risk reward as well. So there was one more thing I wanted to show you guys, a Fibonacci extension. So if you were long in this trade, you got stopped out. And if you didn't get stopped out, right now you're sitting with a pretty nasty account. But if you were long and you took your profits at the level I'm about to show you, then you're looking pretty good. And a couple of traders did. I'm sure there's a couple of thousand folks out there that use this, because it wasn't, I'm sure not a lot of people use Fibonacci extensions, but a good enough amount of people do. So I want to show you here a Fibonacci extension from just a swing low. If I throw in the 30-minute, you'll see what I'm talking about, more defined. So here's a 30-minute chart right here. So right here you see momentum. Okay, once you see price turn around, that gives you cause to say, I need to be, and it gives you price to say, okay, price could possibly go up. So I'm going to actually draw in my retracements from here down to this level there. And so if you notice, price bounces. This is actually the 78.6 level. I'm going to show you. I'll just do this for you. So from swing low to swing. Hey, boom. So you're hitting off right on the 78.6. A lot of people don't play on that 78.6, but if there is confluence at that level, then that's the level you need to be playing at. Okay, I agree to play at the 23.6, the 38.2, the 61.8, the 50, and the 78.6. If there's confluence in those areas, you never know where price is going to stop. Just go where there's the strongest confluence in the area. Okay, and if you notice on the 78.6, there was a pretty high amount of confluence in that area. So what's that mean? That means you can get some profit taking going. Okay, you can sit in that trade until it hits an extension, and I want to show you where that extension is. So let me remove this drawing real quick as well. Let's go from this swing high to swing low. And if you notice, look at that, okay? Right on that 127.2, okay, you have some turnaround. And that's where the market just completely turned around. I think that had to do with the trend line. That had to do with the 50% level. That had to do with the moving average that I didn't mention on the hourly. Notice that. Major hit on that 200 EMA, on the 200 right there. So I'm pointing at the screen, you can't see that. So confluence, okay, you get enough of that, you know where to go. You're not going to be right 100% of the time. You're not going to be right 80% of the time. Be right 65, 70, 75% of the time. You might be able to get to the 80s. But you don't need to get to the 80s. Have a nice risk reward. I want to draw the risk reward metrics for you on this trade. Okay, you don't have to always you don't have to always win. I just want to win maybe once every 2 times I lose, or maybe every other time. If I'm right 50% of the time, I'm making money. All right, I have better strategy to be right than 50% of the time. But just in case, you know, I don't have to be. So to me personally, that would probably be my exit, just because I see this swing. I already know where it would be. I'm just going to draw this up for you guys real fast. So say you entered into this trade right here at, I'm not going to say the wick, no one's that perfect, but say you enter in right around here, okay? Where would your stops go? So if you were looking at this chart, where do you think your stops will go? Okay, here's a swing high, here's another swing high, okay? There's some pretty strong resistance there. I mean, you have options. For me personally, I like to choose the option that's the most conservative. I don't want I know there's going to be swings, 200 pips away, but I want to make money and I want to hit my target. If I don't hit my target, I want to be stopped out if it goes to the next swing. Okay, I'm not going to sit in this trade 4 swings up just because I think there's going to be downside. So personally for me, I would have probably chose this lower target right here. Okay, boom. And that, not only does that give me a good risk reward, it's feasible. This is a swing. Okay, you had some price action trying to hit off on this. It never got there. But if you see in the past, just last week, this was last Wednesday, you see that there was price action. So right now, that's giving you a pretty awesome risk reward. Let's see what the pips are. So you have this here. Boom, boom. Duplicate that cell there. Well, check that out. Okay, so what's that? That looks like probably around the 1 to 1.5 risk reward. It's not bad, okay? You can do better, but again, if you have such high confluence in this trade and you have such high probability, then that's okay to have a positive risk reward. Just get better than 1 to 1. It doesn't always have to be 2 to 1. All right, so that's it on the technicals. I want to get into the price manipulation and why it looks like price manipulation to me personally. And that's because I wrote here influxes of capital. So if you notice on this march right here up to the upside, notice how purposeful those candles look. Okay, notice how constant they are. They're all the same size. Okay, you get a little retracement, that's because there's our retails in the market. But other than that, look at this march. All right, we've been in consolidation in this pair for this entire week, and randomly you just see this march to the upside. That's price manipulation. That's market makers doing something. They're in there, they're throwing in capital because they want to get people into that whole idea of what? Fear of missing out. All right, that's one of the main reasons why market makers make money. It's because a lot of people see price move in a certain direction, they all get in, and then boom, they flip it on them. Okay, that's exactly what you see here. So notice price manipulation. Notice when you're in consolidation and you kind of just see this slow, steady influx of capital. You can see it, okay? There's more examples outside of this that you can see that are market manipulation, but this one was just so obvious, right? So that's really just it. Euro USD, the drop wasn't as spontaneous as you guys might think. Okay, go into the technicals, see what the market's about to do by aligning all the stars. Notice when the market's being manipulated and take advantage of that opportunity. You didn't have to make all 200 pips. You could have made 50, you could have made 100. You know what I mean? You could have made 40, you know, so it just depends on what you were risking. But that's really just it. If you guys have any questions about manipulation, Fibonacci's, whatever, I'm here. Nice talking to you. Dominate the market. I'm out.